on the classical sampling.
Okay.
So I think we'll go to the monetary unit one, which is the hard one anyway. Generally speaking, if people get stuck on one, it's that. And
Okay.
so I put it in the email. It's also in Blackboard under the assignments. Let me see if I have it up. I do, but I need to share my screen. So it looks like that one.
Okay, I'm gonna pull it up now.
And sometimes you'll see this called different things too. It called
Okay. All right, so I got that one up.
okay. Yeah, so you see this called a couple different things. Dollar unit sampling. And you know, that's kind of the same thing as monetary unit sampling. Monetary unit means like if you're using a different type of monitor, you know, using different kind of money, you can also do it. And probably proportional to size.
Okay.
And monetary unit sampling is a weird one because it's designed specifically for auditing. The other ones, the classical sampling, you can use those for almost anything. But the monetary unit sampling is used for specifically for auditing. And you'll find in a second here, but it's you can use either method. They don't tell you which method to use. There's no rules on which one you can use or can't use. Some are better than others in different situations, but there are there is no, just because this one is used for is only for sampling doesn't mean it's a better one. I'll put it that way. It depends on what you're looking at. So what we're going to look at is this cumulative row here. And the cumulative row is just all of the items in the sample added up. Or excuse me, all items in the population added up. So for instance, you'll see the first one is just 500. The second one is 500 plus the 200. And you know, this is going to look terrible. I'm just going to use the original one back again. 1300 would be this, all three of these together. So it's just cumulative. In other words, you know, by the time you get to the third item, all three of those together would be equal to that. And in total, the total book value of these accounts receivable, the total value of these are $5,000. Okay, we're going to take a sample of 5 items to be selected, and this is where it gets a little bit wacky. And I think I'm going to switch cameras here. Okay. Focus. All right, so It's sort of like this. Where's my ruler? Oh, well. Improvise. So it's sort of like this. What we're gonna do is take this and split it up into 5 different chunks, each worth $1,000. And it's all messed up. So, the total of each of these is 5,000. These are called intervals, by the way. So the interval, you get the idea. Okay, so these of them are $1,000 intervals. So we need 5. So we split our 5,000 divided by 5 items. So that's how we got that interval. Now, what we're going to do is pick one item for each one of these and assume that that's going to represent the entire interval. So we're going to pick 1, 2, 3, 4, 5. And whatever those items are, they're going to represent that entire interval. So all we've done is taken and broken up that $5,000 chunk and turned it into a 5 different intervals of 1,000. We're going to pick one item for each one to represent the entire thing. Okay, so let's go back to this. So we want to find the item that crosses the first $1,000 interval. So what item, and we're looking at we're looking at this, the cumulative. So which item crosses the $1,000 interval?
Would that be 3?
Yep. So we're going to pick number 3. That'll be our first item. That'll be the one that, sampling interval. Oh, I just did it. That's 5,000. Oops. No, it's not. I'm sorry. Let me finish this. 5,000 divided by 5 items. Okay. So the first item that we're going to pick is number 3. Okay, now we want the one that goes past 2,000. So which one goes past 2,000?
6.
The number 6.
So we're going to pick that one. And the one that goes past 3,000, 7. Oops.
And then it'd be 9 and 10.
Yeah, 9 goes there. Yeah, yep. So 9 goes past 4,000 and 10 goes past 5,000. So these would be 9 and 10. So these are the items we're gonna pick for each one, and we're going to have that one represent the entire interval. So number 3 is gonna represent the entire first interval. Okay, so let's take a look at it. Item 3. Okay, we're gonna have an audit amount. I did this. Audit amount was in my bid to make this even more confusing, I'm going to highlight the audit and book amounts. And basically, we use it as a ratio. It's sort of like a ratio of $1. Now you notice at number 3, the book value and the audit value are the same. So as you'd expect, there's not a problem with that one. So we'll say 600. I don't know what I did here. Divided by the book value. So the audit value is 600, the book value is 600 also, so they're both 600 times 600. Times the interval, which is 1,000. And that would give us a projected value of, well, 600 over 600 is just 1, so this will just be 1,000. And that's the entire interval, so there is no projected misstatement because everything's fine with that one. Okay, let's go to the next one. Now, the next one's a little bit trickier because the audit value is less than the book value. So we're gonna have a little bit more to do with that one. I'm just gonna copy this because I'm invent the wheel the whole way down here. So this will be 6. Okay, so the audit value is 560. And the book value is 800. Okay, so here, this one you can tell there's gonna be a problem. Right, because this is 560, so this is not gonna equal 1,000. So we're gonna take 560 divided by 800. Calculator out. Oh, my thing's broken. It's still working, we'll leave it. All right, oops. All right, so this is gonna have a projected value of 700. So out of that 1,000, the projected value, what we think it's worth, is 700. So what would be the projected misstatement for that interval, that $1,000 interval?
Would that be the difference? So
Yep.
the negative 300?
Yeah, so we're gonna put in, 300. Okay. And copy that down. Oops. Next one is number 7. And 7 is 450 and 450, so there's no problem with that one. You know what? I should have copied this one. So if they're yeah, if there's no problem with them, they there's no misstatement, obviously. So that's 9. So with audit value is 300. Book value 750, so this is 300. Okay, so that's 400. And so the misstatement would be what, 6?
600.
Okay. And the last one is 900 and 900. And there's no problem there. So we took one item and made it for that entire interval. And we come up with a projected value. And what we're probably more interested in than the projected value is projected misstatement. But we'll add both of them up though, just for fun. Yeah. This is 1100, 4100. And this is 900. So we're saying this thing is this dated by 900. And you know, whether that's material or not, debate. But this would be the amount that we come up with it there, misstated by. Now, in real life, you wouldn't find this many. If you only had 5 items and 2 of them were wrong, you'd probably not have too much faith in it. But you know, I purposely made it a little bit exciting. But anyway, so this would be the projected value using the monetary unit sampling, and this would be the projected misstatement. Now, there is a beauty to this method that is when it comes to the interval. You know, which items are more likely to be picked? Larger items or smaller items? Which item is more likely going to go past that interval? You know, would a $2 one have the same chance as a $200 one?
No, so it would be the larger items are more likely to be.
Exactly. So the larger, the items that are more, which are more interesting to us, right? I mean, if a $2 account is off, it probably doesn't matter too much. But a $200, and notice that if the account gets big enough, if the account gets over the interval, if it gets over 1,000, you're guaranteed that it's going to be picked. So this is why this one is a good one for auditing, that if something here. So that if they're cooking the books, the more they cook the books, the more likely it's going to get caught. And if they cook the books enough on any single account that it goes bigger than that interval, it's 100% it's going to get counted. So let's say that they're having bad sales year, so they increase some of their sales a little bit higher than they really are. The more they increase it, the more likely it's going to get caught. And if they increase any single account over the interval, it's 100% sure that it'll get caught. So that's why this method is a really popular one, especially when people are trying to overstate their books. It doesn't work very well on understatements. Notice if they put a $200 account, if they write it down to $2, it's very unlikely you're going to catch that. So it's really only for overstatements. So these, things like sales, things like assets, and those sorts of things that they would want to increase the books to make them look better. And again, every time they increase it, it increases the likelihood to be caught. And if they increase it over the interval, it's 100% sure it's caught. So that's why this is a good method for some types of auditing. Okay. Now, picking the sample size. This is where it gets ugly. The actual working of it is not too bad, but there are some things we have to do for it. And one thing that you kind of notice is the sample size is related to the interval, right? A change in the sample size will change the interval. So let's say let's go back to oops. If this was, instead of being 5 items, if this was 7 items, it would change the interval. If this was 10 items, it changed, and so you get the idea. So finding the number of items, the sample size, is really important because it also determines the interval of what ones you're going to pick. So anyway, this down here is the kind of the formula that we use. And it's kind of like making a cake. We're going to go ahead and go through and put all these in that we need to. Okay, we start out with a total book value. Tolerable misstatement. Expected misstatement. Oops. Okay, so far we got that one. And now we got to find 2 other things. We got to find the liability factor at 0 statements and the expansion factor. So we need to find these 2 things. So we got the first. Okay, so we have those. Now we need to find the other ones. All right, coming down here. We need the reliability factor at 0 overstatements. And we need this too. One more thing. So we're auditing this at the risk of incorrect acceptance at 5%. In other words, we're going to be 95% certain, 5% uncertain. Okay, so 5% at 0 misstatements. Oops, 3. So this is a reliability factor. And we use it at 0. This is for sample size. So we're going to plug in 3 up here. The expansion factor is a little bit easier in that there's only 1 at 5%. So expansion factor is a little bit easier. Okay, so now we're going to rhinestones. All right. A lot of times it's easier to do these 2 first. And then subtract it from the 120. So what is that? 5. 12 on the bottom. I should put another one in here. Sample size. Okay, so the bottom would be 112. 112,000. And on top of that would have been 6 times 3. 4.8. I hope this doesn't goof up when I do this. Okay. All right, so sample size is 4.8 million divided by 112, whatever that is. 112,000, I should say. 42.85. Now, remember, this is a sample size, so we probably can't take 0.85 or something. So we're going to round that to 43. So let me see here. Or 86. Rounded. And hold on. So our sample size will be 43. The rule for this method is that you round to the nearest item. I would tell you in real life to go ahead and round up all of them, even if it came out to be 42.14 or something like that. I would round it up to 43. One thing you have to remember about doing auditing is that a lot of times this stuff may end up in court. And if you say you round it down, even a lot of people that don't know about statistics might question, well, why did they round down? Why did they round? So to avoid that kind of stuff, I would say always round up. You're only taking one more item. But in this case, rounding off the nearest one would also be the next higher up one. So this would be 43. And so the sampling interval will be total book value, which is this, divided by the sample size. And I'd probably round this off the nearest dollar. It's not wrong if you keep all of it though. 1,000,000 divided by 37,209. So that'll be the interval. Yeah. So this is the sample size. And this is the interval. So you take the one that crosses 37,209, and then the next one will be the one that crosses whatever it was, 74,418, whatever it is. So you just this is how you determine how many items you pick and what the interval is. Yeah. You guys want to do another one of those? There actually is another one on there to do. You think you got it?
I'm okay.
You okay?
Okay. Yeah.
All right. Okay. Well, we'll leave that one to you guys can do you work it on your own. Do that one on your own. This one, the number 3. And I want to get a little bit to this one here. Then we'll. All right. Okay. There are some more rules for what we do with when we find things that are wrong, because there are some things that are bigger problems, some things that are smaller problems, and some things that aren't problems at all when we come to this kind of sampling. So that's where you come into these kind of 3 rules. Okay, incremental allowance. For additional sampling error. This is when in your interval, there could be more things that are wrong. So in the interval itself, there could be more things that are wrong. So, even though we found an error, notice that book value only covered a portion of that interval. So that error, there could be more. And the idea that because there is an error, it proves that there can be errors in it, that it increases the amount of risk, let's say, of that item. So when you find an error, there could be additional things wrong in that interval, that sample interval that they have for that item. Okay. Monetary unit sampling is used to detect overstatements. So this is only for overstatements. And here's where it gets kind of funny. Understatements are ignored. And this really, as an auditor, you find something that's wrong, you say, okay, well, this is wrong. And in this method, though, If it is an understatement, it's not wrong, it's fine. You ignore it. This method is only used for overstatements. If they do find an understatement, it's simply ignored. And again, it goes against your grain as an auditor when you're going through these and you find something that's incorrect, and then, you know, what the rules are, you ignore it with this method. So it's not supposed to find them. Okay.
So is there,
Okay.
sorry, Professor, so is there another one for like understatements also? Because, I mean, when you're auditing, if it's wrong, it's wrong.
Yes.
Yes.
Okay.
Excellent question.
You would go to the classical sampling. So let's say, let's take something that could be understated, you know, that it could cause problems. Let's say understating expenses or liabilities. You would use a classical sampling for that one, because if they were trying to cook the books, more likely they would be understating those. So yeah, things that are understated are usually use classical sampling. Or if you're not sure, you know, there's sometimes people want to increase their, you know, their revenue to make it look better so that, you know, the company can get financing and all that kind of stuff. But it also could be that they don't want to pay taxes, so the revenue could be understated. If you don't know, classical sampling is the way to go. So that is one of the confining things to this method, is it's only for overstatements. You definitely could take two different samples. Take this sample to see if there's any fraud, and if there is, you know, hopefully you can catch it. But you, is for overstatements, but also you could do one, you know, the same one for classical sampling. So classical sampling you can use for anything. This one is only used for overstatements. And that's why, you know, when I was going through, they kind of said, oh, this is the one to use because, you know, it's for auditing. Well, it's a good one to use in certain circumstances. In other circumstances, it's not the right one to use. And the ACCP is very clear about saying, look, there is no one that's better than the other. It's simply what you, you know, what the population dictates. Okay, the third one. And this is when you have items that are larger than the interval. So like we were saying before, you know, what happens if you have one that is, well, let's take the very first example. We had $1,000 intervals. So if you picked one that was, say, $1,400, you're guaranteed to pick it. It's going to cross at least one interval. It may even cross two intervals. So if you, let's say you find one that's you know, is 1,400. Okay, now here's the thing about that interval. There's nothing else in that interval. So if the item you pick is bigger than the interval, nothing else could go wrong. Right? Yeah, there's nothing else in that interval. So there won't be any what we call incremental amount to it. You know, you found whatever you found in there, the actual amount, you know, is going to be, there's not anything left in that intervals. It's almost as if you've taken 100% sample of that interval. You know, if you took 100% sample, whatever is wrong is wrong. There isn't anything additional to it. So that's another kind of quirky thing about it. And we'll see how this all plays out down here. Okay, so we got all of these. Don't worry about the incremental allowance just yet. We'll talk about these later. You know, so postpone this over here, this little column over here. Let's leave that alone. And what we're going to do is come down here and do the projected value. The first couple of ones of these, the first few ones are okay. We can just go ahead and do them. They're not, nothing too much happening with them. All right, so the interval is 40,000. And so just like we did before, we're going to take the ratio. We'll come here. All right, and we get a projected value, whatever that is. 8,000, I think, isn't it? Let's see. Yep. Okay, so the projected value is 28,000. And so the projected misstatement is what, 12? I can bold all these. Maybe I can. Okay. So that one's okay, you know, you notice that the book value of the item was less than the interval, so there's not a problem there. Okay, so we'll go to the next one again. $2,000. Happy with this. Oh, this is 32,000. This is what, 8? Okay, this one here is, notice that the audit value is 0, so this account is worthless. I gotta make a statement on this one though for a second. So 0 times 40,000 means our projected value is 0. Projected misstatement is 40,000. And I'm going to stop on this one for a second, and that is because sometimes you'll see in books, they'll say that if the audit value is 0, that you must investigate as to why it's 0. Which is what you're doing anyways. I'm not sure why they even say that, but you always look and see why it's, you know, 0, why is 0. But anyway, you'll see in some books that if it's 0, that you should see why it's 0. But if it truly is 0, then, you know, that means that projected value is 0 and the projected misstatement is 40,000. Okay, number 5. No, I'm sorry, number 4. Number 4. What's unusual about number 4?
The audit value is higher than the book value.
Yep. So this is higher than this. We ignore it. So for this method, and again, if it as an auditor, yeah, you do say, well, wait a minute, that's wrong, but so this would be projected value is 40,000. The misstatement is 0. So this one actually isn't a problem at all. For this method.
So quick question, Professor. So if you were doing this method and then you found this in one of the samples, would you then switch to the other method just because the fact of there is that error right there?
Possibly, and you know, and it matters how big it is too, and if there's a problem, if you're doing a big sample and you got one of those, probably not that big of a deal. But if you're doing a sample, and let's say you ran into 5 of them, you say, well, wait a minute, this might, this might be going the other way. So, yeah, it really depends on like the size of it and that. If it's 1 or 2 maybe, or depending on how big your sample is, it's a judgment call. Yeah, and yeah, so that if you were to run into a problem that, hey, these are, a lot of these are understated, then absolutely, change the method, or at least run an additional sampling using classical sampling. Yep. Okay, so this one, according to this method, is not a problem. Okay, now down here, this is where they get strange. So they have on their books this item for 44,000. The sample size, interval size is 40. So this was 100% certain that we were going to pick this one. So we're 100% certain that we're going to pick this one. The entire sample is covered by this one item. What we're going to do instead, well, here, don't. I'm gonna do it the way we've been doing it. Don't do it this way because this is wrong. So here I'm gonna do it wrong. If you were to take this and go, okay, let's do this. Let's so what is that? 25%. So this would be, oops. So this would have been what, 10,000? So don't do this. This is wrong. I'm doing it the wrong way. And the misstatement would have been 33,000. Nope, it was 30,000. So if we were to do the same thing we've been doing before for these up here, we'd run into this. The misstatement would have been 30,000. Here's the problem. The actual misstatement is, so we know it's off by, oops. This thing is actually misstated by 33,000, and those are not projected. That's a real misstatement. So notice if we were to use this, the projected misstatement of 30,000, we would really be missing out on the actual of 33,000. In other words, the projected is lower than the actual. When that's the case, we skip all this multiplying stuff and we go right to the actual. So the actual will be used when we have this problem of the we have this where the book value is higher than the interval. You use the actual. And again, it's because if we were to do the ratio, it would show a misstatement of 30,000, whereas we know actually this thing is misstated by 33,000. And it has to do with the book value being higher than the interval, you know, higher than its chunk of the total. And because of that, the projection would be decreasing it from a book value of 44,000 down to a book value of interval of 40,000. And so it reduces it by whatever the ratio is. 40, I don't know, by some amount. 10%, right? Yeah, 10%. This is 10% higher than this, so it would reduce the projected misstatement by 10%. So again, this is the wacky one that if it is more than the interval, and the same thing goes true down here. Notice this one is 90,000. This will cover at least 2 intervals, maybe 3. And we do the same thing with it. We do the actual misstatement. Just gonna copy this down and plug in the numbers. Oops. So the actual misstatement down here is what, 90,000 minus 65,000. 25,000? Check that.
Yeah.
25,000. Okay, so that's what we would do for that one too. Oops. What, I messed that up. Oops. All right. So this would be 25,000. Okay, so what we're gonna do is, now notice that, and a lot of times they'll do this in the problems they give you for these for this method, is that these are the items that were found with misstatements. In other words, these were the only ones that we found that had problems. The rest of these didn't have problems. So we're just gonna look at the misstatements here. So what we're looking at here are the misstatements. And actually, we could figure out though how many items were actually in the sample, because it has to do with the interval. If we were to divide this by the intervals at 40,000, that'll tell us how many items they picked. That 20? 800 divided by 40. Yeah, so there's 20 items in the sample. And those 6 down here were the ones that we had problems with. So this misstatement, this is for the entire 20 items, but we're gonna add all these up, so whatever these come up to. $118.
At 107.
Here's my calculator. I think it's 118, isn't it?
Yeah, it is. I'm doing it in my head, sorry.
Okay. Well, that's what I was doing it too, so. Okay, so this is our best estimate of the projected misstatement. And our best estimate of the accounts receivable balance is at 800,000. Minus 118. 682, maybe. Okay, so our best estimate, so this is a rejected misstatement. So our best estimate as far as what this thing is misstated by would be, or excuse me, what the projected value would be 682,000. Okay, now this incremental allowance. The incremental allowance is there because those items that don't cover the entire sample, there could be more things wrong in that sample, because notice that book value is overstated, so it pushed out some legitimate accounts and so forth. So, or accounts that were bad. So there might be more wrong with those intervals because the item that we picked did not cover the entire interval. Show you what I mean here. Like, for instance, this one, the book value was 20,000, the interval was 40. So there might be still more wrong in there. So incremental allowance for this one would be yes. Because there still could be more wrong. Second one also, this was 3,000. So it's less than it, so could one be wrong? Yeah, same thing here. As long as the book value, the item we picked, is less than the interval, there still could be more things wrong in there. Number 4 really isn't an error in this method, so it's not wrong and nothing else could go wrong. But down here, for these two, nothing else more could go wrong. They cover the entire interval. This one covers at least 2 intervals. So for these two down here, there would not be any in what they call incremental allowance. And if you're wondering what the incremental allowance is, we'll talk about that next class. On Thursday. It's also in the video for this. A couple more things about this method that really make it appealing. First of all, it's it finds overstatements. So the more that they try to cook the books, the more likely they're going to get caught if they're trying to cook it with overstatements. The sample size is, and I know it's kind of a pain. We had to do little calculations there, but finding the sample size is way easier than in classical sampling. You notice when we did classical sampling, we didn't find the sample size. And I don't think it's ever been on the CPA exam. Sample size for probability proportion or planetary unit sampling has been on the CPA exam. But they've never put the classical sampling one on there. And the reason is it's pretty complex. For one thing, you have to find the variation of the sample before you pick the sample size, which means you have to do a pre-sample, basically. So finding the sample size is very quick. Also, a beauty of it is you don't have to actually go to a number table and pick the sample. It picks it for you. Whichever one crosses the interval, that's one you pick. You know, we don't have to go down the table and say, okay, we're gonna take, you know, item 3 and item 17 and item whatever. It's automatically picked for you, whichever one crosses that interval, that's the one you pick. So there are some things that really speed up this method besides just the, you know, the beauty of it that it catches overstatements, you know. Doesn't catch understatements, big, you know, is that a big problem? Yeah, depending on what sample you're looking at, it could definitely be. Okay, so we'll pick up this other here. And this part down here is kind of wacky. This is where we get to the incremental stuff. This is where, you know, that you can find a bigger problem with it. Question on that? Okay. If you want, you can jump right into the monetary unit sampling one. And if you go about halfway through, it'll get into problem that was, I think, problem 4. You know, and you can go on from there. But also next Thursday at 7, we'll also you know, talk about it. We'll go through the rest of it if you want. Now, so Christina, you had a problem with the book?
So yeah, so now, so this looks like I have the right one. So I just been like going to like the chapters based off what you have in the syllabus and like they align. So I guess I'm okay now.
Okay.
For some reason, like when I was looking at it the other day, it wasn't this, but I've been in contact with Cengage, so maybe they like updated something, but this wasn't the book that was like this
no.
wasn't.
Well,
Sorry.
well, one thing they had a problem with before was that they had all the problems were all numbered 1. which is a real problem when you're trying to assign problems. It's like, do problem 1, do problem 1, do problem 1. Switch number 1.
Yeah.
But yeah, so anyway, the yeah, so hopefully that we're done. And so on Thursday, you know, whatever we want to go over, we go over. I mean, whatever you guys did. If you work through this and you want to go on to the next thing or whatever, that's fine too. I did put the handouts up on the for 1 through 3. You know, I put up the 5 and 6 ones too. You know, that we do after the sampling. But if we get the sampling in by this week, I would be happy with it. You know, I think that's pretty good progress. I don't know if I told you guys this or not, but the everything is basically, this class is what they call asynchronous. Whenever you finish it, you're done. So everything is actually due on October 22nd. I put due dates on just to kind of keep you know, try to keep people on track, whatever. But honestly, the due dates, the true due date for everything is October 22nd.
Okay.
My point being is, if you miss the deadline, oh no, I missed the due date. You didn't really miss the due date. You still turn in and get full credit. So. All right. Okay.
Thank you.
All right. Well, I tell you what. So we'll pick it up next class, and this one is, you know, they say this is the trickiest one of all of them. The first one and the third one are not too bad. This one tends to be a little bit more wacky, and you're never going to see it in any other class because, you know, it's just in auditing and fraud classes you're going to see this because it's specific for auditing. All right. Okay. Well, I'll see you guys on Thursday, and we'll go over whatever you want to go over.
Okay, thank you
All
for.
right, thank you.
Okay.
Have a good night.
Good night.